Good afternoon, everyone, and thank you for joining us today for our Market Insights with Professor Jeremy Siegel webinar. I'm your host today, Michael Kovacs. I'm the CEO and founder of Harvest Portfolios. And I'm pleased to have our guest today, Jeremy Siegel. He's got quite the resume. He's a professor of finance at Wharton School at the University of Pennsylvania. He's an economist and renowned speaker on financial markets. He's a frequent guest on CNBC, Bloomberg Television, CNN, and a number of other networks. And he's an accomplished author of Stocks for the Long Run, which is now in its 6th edition. So we're very, very happy to have him on our show today and to talk about what we're doing at Harvest and how a lot of what Professor Siegel is talking about really fits into our philosophy. So that might be a great segue for me to sort of talk about Harvest and the development of this company and the fundamental sort of investment thesis of this business with Stocks for the Long Run. I was very fortunate in my early career. I was a stockbroker in the late 80s, and I came across two individuals, actually. Number one was Warren Buffett, and then not long after that, Professor Siegel. I remember reading a Forbes or a Fortune magazine about billionaires, and there was Warren Buffett there who had made his fortune as an investor, which seemed, odd when you're an advisor and you're trying to sort of figure out how to build an edge and how to grow a portfolio. And here was this guy who had done it over the last 30 years or so at that time. And it really came down to that philosophy that I took into my career at that point in time, and worked for a firm for a while that sort of focused on that same philosophy of just choosing stocks like businesses, buying a piece of a stock as if you're buying a piece of an entire company, and holding on to it for the long term. Because what a lot of us forget as investors is compounding growth by owning great companies over long periods of time is a great way to compound your wealth. And also, very important, is how do you defer or push back taxation, capital gains taxes, for example. The longer you hold something and don't sell, the longer you can defer those capital gains. So we took that philosophy, a great part of that philosophy, and built it into what we do here at Harvest. Also around that time, a colleague of mine told me about Professor Siegel and this book, Stocks for the Long Run, and said, you really should read this book. It has a lot to do with sort of the same attributes that Warren Buffett talks about. So I actually went out and bought the book. And this is edition 2 from 1998. I still have it, obviously. I still have my Buffett books. And again, it just sort of boils down to long-term thesis about markets, getting through the noise, taking a long-term approach to stock markets. So I feel very fortunate that we've been able to build Harvest on these premises. I think it's important to think about as well, like, where is wealth created in the world? And, whether it was 100 years ago or 200 years ago or currently, the formula hasn't changed. I mean, if you think about the Mellons, the Carnegies, Henry Ford, today you've got Bill Gates and Elon Musk and Mark Zuckerberg and all kinds of these individuals. They have not created their wealth, or Warren Buffett, they have not created their wealth by buying and selling their stock. They've created their wealth by taking long-term approaches to markets, building their capital, letting those shares over time grow. And whether Warren Buffett likes it or not, he continues to hold companies like Coca-Cola, Gillette, See's Candies, Geico, a number of these companies he's owned out throughout 40, 50 years of Berkshire Hathaway. So it's that long-term approach that we're trying to follow, and we're trying to boil down into our investment philosophy at Harvest. So when we founded this company 15 years ago, the idea was to take the same long-term approach by owning great businesses, trying to choose industries that we see that had great growth prospects, and then isolating what we felt were the great companies in there to hold. If you think about tech or utilities or real estate or healthcare, we've had the same names in those portfolios throughout. Our healthcare fund is now approaching 10 years old, and Eli Lilly's been in there since day one. And Eli Lilly is very popular now. There's a lot happening with that company, with the weight loss drugs and so on. But that's a member of that portfolio for 10 years. So is Merck. So is United Health. And, you know, it's never a straight 45-degree angle up. It's choppy. Things can move around. There's news coming and going. But if you feel confident and you really believe in that business and what the management's doing, then you stay with that company. And from time to time, you have to knock out a name or replace it. But generally, our philosophy is to hold those businesses and compound growth for the long term. Then we take that and we overlay our option strategy on that, where we only write on our equity portfolios about a 33% position. So that way we've got 67 or more percent tied to the growth of the market, while we're monetizing and capitalizing on the option premium to generate that additional income. So we're drawing out dividends, we're drawing out premiums, and we're paying that out as income to our unit holders. So this all boils down to what we do at Harvest. And to get back to Professor Siegel, it makes sense to have him on this program today to talk about stocks for the long run, markets today, some of the long-term thesis about markets, and how you should look at that as investors. So with that said, I'd now like to turn it over to Professor Siegel and let him take you through his part of the presentation. Welcome, Professor.
Thank you very much, Michael. It's great to be with you. Got a lot of slides. I'm going to go through them somewhat quickly. We can always go back to them, and we're going to have a question and answer session at the end. So let's see if I've mastered share video, share presentation over here. We'll see if you can see this slide. Is that visible, Michael? I think so.
Yes, it is. We can see that.
Great. That, you know, you're so right, Michael. Seeing the long-term trends through the noise, this is the most important slide in the book, Stocks for the Long Run. I have 165 charts and tables. This was the chart, how wealth grows in the major classes of assets, stocks, bonds, treasury bills, gold, and the dollar, going back further than any other research at the beginning of the 19th century. And when I saw that line, my colleagues, I said, you got to write a book about this, Stocks for the Long Run. And since I've written 6 editions of the book, some people have called this graph, they said, Jeremy, if there was ever a Nobel Prize for a graph, it would be this one, because take a look at that stock line at the top. This is, now what do I mean by total real return? I mean capital gains plus dividends or losses, capital gains or losses plus dividends after inflation. That's what the term real means. That's the return you want, real returns. And the average compound annual real return in the U.S. stock market over the last 222 years has been 6.8% per year after inflation. Astounding. Truly astounding. I did the first edition of the book. Michael has the second. First edition came out in 1994, 30 years ago. When I finished the 6th edition, went back to the first edition, looked, well, what was the real return I got then? 6.8% a year. What has the real return been in the last 30 years? 6.8% per year. Now, of course, some years it's 25%, and some years it's minus 20%. All those wiggles that you see in the line in the great bull and bear markets, that's all the noise. If I were to summarize the returns of major asset classes, I would say the following. History says that stocks are, yes, the most volatile asset class in the short run, but the most stable asset class in the long run. More than doubling the real return on bonds, 3.3%, treasury bills 2.5%, gold 0.6%. The dollar, that's how much it's worth, which is worth $1 in 1802 and almost $1 in 1940 before World War II, and has lost lost 96% of its purchasing power over the last 80 years. That's the decline of the dollar. But let me tell you something. It has not affected return on stocks. Real returns, stocks are claims on real assets. They're claims on plant, equipment, copyrights, trademarks, intellectual property. These are real assets. These are assets that will overcome inflation over time. I mean, I predicted that would happen, when I started teaching 50 years ago, and it absolutely has happened. So you want a long-term hedge against inflation, you've got it with stocks. And this really shows it. Now, let's talk about, I've been critical of the Fed. And I'll talk a little bit about what I think about the Fed, what they should be doing in a moment. First of all, what they did, they caused this inflation. They took all the debt that the government floated for the COVID relief and just turned it into money, which they're not supposed to do. I'll show you that in a moment. And then, by using outdated inflation data on housing prices, they underestimated inflation, thinking it was temporary, back in 2020 and 2021, and then actually the data shows we've actually solved the inflation problem. Now, that may be clear. I know you guys are smart, but so many people are under the misapprehension. We are not going down to the prices pre-COVID. The question is, we're at a new higher price level, and we want to get that to 2%. I think we're there. All right. So, some people think solving inflation is getting back to 2019 prices. That's not what the Federal Reserve ever said it was going to do. And that's not what is called solving inflation. All right. So, first of all, here's the money supply. And listen, I did my work at University of Chicago. Milton Friedman was my colleague. My first teaching position, 1972 to 76. He told me if there's a burst in money, there's going to be a burst of inflation anywhere from 12 to 18 months later. Well, take a look. We were increasing the money supply 5.3% per year, and then bang, March of 2020. We all remember that. COVID hit, and the government spent like a drunken soldier. Or sailor, I guess. Or either. In 4 months, we increased the money supply by 17.5%. That's 4 months. That's not annualized. And then we continued to increase it at 12% a year for almost the next year and a half. I was saying way back in April of 2020, we're going to have 10, 15, 20% cumulative inflation, which is almost exactly what we had. When the Fed, everything is temporary supply chain disruptions, etc., it's going to die down. No, it ain't going to die down. But then they slammed on the brakes. So here's the latest money supply since March of 2022, right up here. And they, raised rates, clamped down the money supply. Money supply has been really pretty stable. And in fact, my sense, a little too tight now. We might be a little bit worried about what might happen. I want the Fed to begin to lower rates cautiously. We'll talk about that in a moment. But we are above the trend line over here, as you can see. Now, there was all this fiscal stimulus that took place, $7.25 trillion, the first two packages under Trump, the next two under Biden. And this was the problem. The Federal Reserve didn't have to give them all that money. They should have said, go to the bond market and get it yourself. Interest rates would have risen in 2020. We would have never had as much inflation, anywhere near the amount of inflation we did, had the Federal Reserve said, okay, you raise that money. I'm not going to hand it to you and print it, but he did. He handed it and printed. Take a look at money growth. This is 150 years of money growth. In 2020, the pandemic year, 25.8%. Higher than World War II, higher than World War I. And then bang, slam down the brakes. Yeah, I got worried there, If he was going to go to 6 or 7%, we'd have a recession. Luckily, stopped at 5.33. I'll tell you why I think we should be lowering it. All right, here's why we should be lowering it. Here's the government inflation measure. Something called the BLS, Bureau of Labor Statistics. That's the gray line. That's the official inflation line. However, we have on the ground either Zillow or you take Apartment List, which is another on the ground. That's the best one of all, of what kind of inflation increases there are. Actually, negative 8.8% over the last year. What does the government do wrong? They only count inflation in housing when someone's lease comes up due. So you have a 2-year lease, they say no inflation until you renew it. That's crazy. They don't do that with anything else. They don't do that with automobiles. Average American buys an automobile every 7 years. They don't say, oh, you don't have any inflation until you buy your new automobile. No, every month they compute new automobile prices. But for reasons I won't go into, it's not how they do that. So they're way lagged. By the way, here's the median price single-family homes year over year. You can also see that's gone back to zero after surging by a near record amount in 2021 and 2022. Here's Apartment List on a month-over-month basis. Down arrows are negative and up. This is not seasonally adjusted, so that's why you see increase in monthly rates in the spring and early summer, and then down. This is where we stand. So really, we had huge inflation in 2021, not recorded by the government because people didn't turn over their leases. Then a little less in 2022, and then the negatives have outset the positives since then. Now, why do I say that? Housing is 41% of core inflation. And that's what he looks at, core inflation, which is really zero now on housing. It's almost 50%. All right. By the way, in light of mine and other criticism, the government has a new rental index here. See government new rentals? And it does show zero increase right over here. The BLS data, again, the official government data, upon which the CPI is computed, upon which all contracts are computed, all Social Security is computed, all, escalated by CPI, that's computed with government data. Do you see how lagged it is? It'll get down there. I'm not forgiving them for what they did. By saying that they're down to their target, I'm not saying what a great job they did, because they shouldn't let the inflation get out of hand the way they did. Right? I'll share with you. One reporter, I was asked on the air, and they said, Dr. Siegel, looks like, Jay Powell was pulled a rabbit out of the hat. We're getting, a great economy, no recession, and inflation's coming down. Don't you think he's great? Don't you think he should win the Nobel Prize? I said, absolutely not. I said, giving Jay Powell tremendous credit is like applauding a drunken driver who ran over a pedestrian, but then picked him up and got him to the hospital in time to save his life. Is he a hero? No. I'm not going to forgive the mistakes that he made early. We wouldn't be in the situation that we're in today. By the way, we here at Wisdom Tree have computed our own inflation rates. This is the core inflation rate, and then the overall. The actual headline is on the top panel. Core is on the bottom. If you put in the new rental rate index of the government or our rental rate, we actually do a Zillow Apartment List weighted average. You find that year over year inflation is down to 1.9%, which is below the 2% Fed target for both the overall and the core. The Fed should start lowering. The Fed is there. Why are people unhappy? Take a look here. Wages and prices over the last 4 years has gone up almost the same, 20%. Home prices, though, home prices have gone up 46%. And the cost of home ownership, which is an 80% 30-year fixed mortgage, has gone up 113%. There's 100 million Americans who don't own their home but want to. they've been priced out of the market. You want to know why a lot of people are unhappy? That's a lot of reason why people are unhappy. All right. Now, let's talk about interest rates. We know about the Federal Reserve. We know about inflation. But there's a couple other things that affect interest rates. Economic growth. And here's something that a lot of people don't consider, but very important. How good a hedge are your bonds against inflation? I'm going to talk about that in a moment. But before I do it, I want to talk about economic growth. This is real GDP growth year over year over the last 70 years. And then a 10-year moving average is that purple line. We had a big manufacturing boom in the 50s and 60s, good for growth. The internet boom followed in 2000. Are we going to get an AI growth spurt? I think so. I'm positive on AI. Seems like they're going to be, maybe in the next 5 or 10 years, another spurt of growth. That raises interest rates, by the way. Growth causes investment, borrowing, and that requires higher interest rates. But let me show you this factor here. So ignored. I have two graphs here. The blue graph is the yield on a 10-year treasury that gets quoted every day along with the Dow and the S&P. But the dark line here, that is a rolling correlation between stock and bond returns. It's positive if stocks and bonds move in the same direction, negative if they move in different directions. Now, you want a negative return correlation. You want a correlation that's negative because that's what a hedge asset is. It goes down when the market goes up and up when the market goes down. And 10-year treasuries were excellent hedge assets between the year 2000 and 2020. That's why people were buying them, insurance policies. All right? They're good for risks like recessions, pandemics, financial crises, geopolitical risks. But they are not good for inflation risks. Inflation strikes, you're going to get walloped on your bonds as well as your stocks. They're not good. So if you think in the next 10 years we're going to have maybe another set of inflation, I know you are going to be very wary about those bonds. And that's another reason why yields have gone up. It's not just the Fed. It's growth and how good a hedge are your treasury bonds. All right. Is rising government debt a threat? Well, you guys all have seen this, the debt to GDP ratio rise. Right, we're right over here now. Just at the end of that, it looks like it keeps on going up. But let me show you another graph over here. This is how much is held by Americans, the rest by the rest of the world. Whoa, that doesn't look quite as bad. It does start going up, but it takes it all the way to 2043 before it actually surpasses the end of World War II. But let me show you something else. This is the amount of debt relative to wealth, which I think is more relevant than the relative to income. And by the way, all the way until 2054, if you take the amount that's held domestically, then it just touches the level we have here. Now, I want to get a bottom line here. I'm not one of these let's all panic about debt people. I think it's a problem. 10 years, 15 years down the line, we're going to have to do things about Medicare and Social Security, although Medicare is 4 times more difficult than Social Security in terms of the deficit. But I do not think there's going to be any immediate crisis on debt. I would like the government to spend that less. I don't say I love it, but I'm just telling you, I've always been saying that all these people have been crying chicken. Oh my God, the government debt is going to crash your economy. Well, they've been wrong every time the last 20 years. And they're going to be wrong in the next 5 or 10 years. Then they might be right in 2035 to 40. That's not going to really affect the stock market today. And that's assuming we don't do anything. All right. Bond forecast. We're going to be higher, certainly, than pre-COVID. I think what we call R star, the natural rate of interest after inflation. Fed thinks it's only 0.6%. I think it's risen to 1.5 to 2%. We add 2% inflation, that gives us 3.5 to 4%. That's where I think we should lower that Fed funds rate by 2 percentage points. We're now at 5.33. Long bond, I think, is going to stay in the 4 to 5% range that we have now. 10-year Treasury tips in the 1.5 to 2%. I think we're just at 2% right now. What about stock forecast? Well, to measure real return, we take a look at the price-earnings ratio. All right. 2024 earnings estimates of S&P are $241 a share, 2015, $276. The right way to do it is look 12 months forward, so it's half of one, half of the other. It's $259 on June 19th, which is today. The S&P is selling $54.87. That's 21 times earnings. That implies a 4.7% forward real return on the S&P after inflation. After inflation. However, take out tech, they're 18. That's a 6% real return. Yeah, well, tech has to keep on growing real fast. It's pulling that market up. Ex-tech, we're at 18 times earnings. Now, people say, well, Jeremy, 4.7, that sounds so good. I can get 5.5 on treasuries. Be careful. Treasuries are promises to pay dollars. They're not real returns. Right? Right now, 10-year tips are, 2.1. Actually, I looked at it today. It's 2.0. I say we're 4.7. We're almost 3 percentage points higher on stocks. Long-run average is 3.3. So we're not that much difference. 3% a year difference compounds to give you an awful big change in wealth over 10, 20, 30-year periods. Are we in a bubble? Back in January, a Fortune reporter asked me, Jeremy, does it look to you like 1997, the beginning of the internet bubble that peaked in early 2000? I said, nope, not yet. He quoted probably the most famous op-ed piece I ever wrote. I'm reproducing it here. It was March 14th, 2000. Entitled Big Cap Tech Stocks Are a Sucker's Bet. You guys have all heard of the Magnificent Seven. Well, here, these big cap stocks, Cisco Systems, AOL, Oracle, Nortel, Sun Micro, EMC, JDS, Uniphase, Qualcomm, and Yahoo. Those were the Mag 9 back then. I said that they were ridiculously priced. By the way, the NASDAQ, which they dominated, peaked on March 10th. That's when I wrote the article, sent it in. They published it the next Tuesday. I show you a graph of NASDAQ at that time. By the way, if you think I'm some genius and some of the best forecaster, I'm going to give you the truth, guys. Hitting it, as I did on that article, is total dumb luck. Wall Street Journal called me a week before and said, you see what's going on in the market? Do you think it's right? I said, no, write me an article. And I did. By the way, I went back and I found my Excel sheet over here. This tells you a little bit more detail. And let me tell you why we're not there yet. Do you know those stocks I mentioned to you? You know what the average PE ratio was? 200. All right. What about the Mag 7 today? Well, 33. I'm adding Netflix. Forward-looking basis. That's a big cry. Big cry. Now, can it get crazy? Of course, anything can get crazy. Is it crazy now? No. Is it right now? Well, high expectations, but not crazy. The momentum is there. Could it get there? Yeah, but it would require a lot higher prices on those stocks than what we had in 2000. By the way, here PE ratios around the world. And as you can see, here we have S&P here 22 times 2024 and 19.7 times. Actually, these are today. I didn't update this date, but I actually did it this morning for you. NASDAQ is 32 times earnings this year's. That's the highest. Europe is 13.9. Brazil is 7.4. Mexico is 12.5. The Topix in Japan is 15. Hong Kong is 9. Shanghai Composite is 12. Australia is 18. The world is 18, but half of the world is the U.S. You take out the rest of the world, you got 14 or 15. Cheap. Not growing as fast, but cheap. Just want to finish up here because we want time for questions. The S&P tech sector is selling for 30.4 times earnings. By the way, the tech sector back in 2000 was selling at 80 times earnings. Well, 55, 60 right over here. X-Tech, 17.8 times earnings. Value relative to growth, not as cheap as we were at the peak of the bubble in 2000, but really cheap. All right. Normally, value stocks sell at a 38% discount on PE ratio to growth. Now they're at a 46% discount to growth. Small stocks also. Normally about the same PE ratio, now at a 30% discount. Let me end it over here by giving you that first graph. We can go back to any of these graphs. I'm happy to answer your questions. Yeah, there's going to be volatility. Yeah, there'll be a bear market in the future. No one knows when. Yeah, it'll scare us all. We will wonder, should we be in stocks or get right into treasuries? But take a look at history. Take a look at history. These wiggles here were the great bull and bear markets over time that dominated the headlines. But when you take a look at the long run, they're mere blips in the upward thrust of stock values. Well, thank you very much for your attention. I'll stop this at this time so we get back and see Michael.
Hi there, I'm back.
And Michael, you shoot away with any questions you would like to.
Okay, well, thank you. That was a great overview, great empirical evidence. And when you put things into the long run perspective, you really show all those little blips really mean nothing over the long term, which is fantastic and sort of ties into what I was mentioning at the beginning. So, Professor, we've got a number of questions we just put together here because we have a fairly large audience. One thing we can always count on in markets, and you were talking about that, is noise. There's all kinds of noise out there. Can you discuss the current market conditions and sort of build the case for long-term investing today if you're an investor stepping into these markets?
Yes. Okay, so I think outside of tech, you got real sound values. Tech is a question mark, but it's nowhere near the bubble as I showed you that we were in 2000. Now, who knows how high it could go? It could go, it could double or triple on some of these tech stocks before they crash. That's what happened 24 years ago. But if you stay away from them, and I'm not saying, again, because if you did stay away from them, you haven't performed as well as the index. And I think what's going on now is a little bit of FOMO. I mean, a fear of missing out. My God, I haven't hold these stocks and go up all the time. I got to hold them. But so I think they're actually probably going to keep on going up for a while. But even if you want to hold them, as a diversified portfolio, that's how you hold the S&P, even though that 30% of or 25% of it is tech. The real return on that going forward is still 5% after inflation. I think if you hold non-tech in the long run, the return is 6 to 6.5. So even if you hold it and tech corrects, you're going to way be ahead of fixed income assets by being an overall stock investor.
Right. And so actually, since we're talking about tech, one of the hot areas today, as you know, is AI.
Yeah.
And are there specific sectors or innovations that you think are going to shape or reshape the landscape of investing?
Yeah, I mean, as I said, I think AI is going to increase growth. I'm not an expert on AI. I'm not, one of these people who certainly I'm not a tech guy so much, but an economics guy. And people I respect and firms that I respect have told me that they think it could increase GDP growth by up to 1.5% per year starting in 2025, 2026, as firms be able to really make use of it and substitute away from more expensive production of in their chain of supply. And that is higher growth. It's good for margin, good for profits, good for GDP. It does mean higher rates too, because it means investment, but it also means productivity, and it means higher standards of living. Because ultimately, technology and productivity raise real wages and raise the standard of living.
Right. Okay. Well, you mentioned interest rates a few times. It's just sort of the elephant in the room right now. So what are your thoughts about sort of the shorter term and longer term direction of interest rates?
Well, I gave you my long term. I think ultimately we will be in the 3 to 3.5 range of Fed funds. We're now at 5.3. I think the long bond, 10 years, about where it's going to be. Mm-hmm. So you say, well, how do you get a short? The short one will drop and the long one doesn't, because we need what's called a normal slope of the term structure, where the short end is lower than the long end. And that's the normal shape. We've been inverted for a long time. So far, we've been lucky, but not caused a recession, as it often has. And I think we will avoid a recession. Maybe a little slowdown, but we'll get short rate. Now, the only thing I worry about, the Fed has got to be on its toes. I do see some signs of slowdown in the data. I mean, retail sales were weak. Jobless claims comes out every Thursday. Tomorrow we'll get, another one at 8:30. I look at that very closely. I said the range that I like is for the jobless claims to be 200 to 240. Well, it just peaked above that last week, up to 241. We'll see if it keeps on moving higher. Again, that doesn't mean recession, means slowdown. We had a good manufacturing report right after that rather poor retail sales report that we got for the month of May just a couple days ago. So I want the Fed to be looking at. I think they are, but if he thinks he should lower it, he's got to lower it, because 5 1/3 is just, given the real inflation, given the term structure, is just too high to persist at that level.
Yeah, well, not to keep talking about interest rates, but I mean, I got a bit of a two-part question. So if we talk about the role of inflation in the economy, we know that some inflation actually is a good thing. You don't have zero inflation. Some inflation is a good thing. Is 2% a realistic target? And I guess the second part of the question is, how do you think that level of inflation would affect stock markets?
Well, I actually think we should be 2.5 to 3 as a long run, but you can't change you can't change the rules in the middle of a game, especially when you overshot some target. So they're keeping it as 2. Whether they go down that far and whether they finally have a meeting and say it should be higher, that's a question for the future. He cannot do that later. I can kind of do it by default. Let's put it this way. I say you're at 2 if you put good data in it right now. Mm-hmm. And I think within 6 months and a year, when that data flows in it, you'll be there. But I think there's a good case for raising it, because 2% as a target, as inflation, if you get a recession, you may need to lower interest rates, and you can't lower them below 0. And so that's called the lower bound rule. And if the higher the rate you make that inflation, the more a lowering of the rate can stimulate the economy. But that is not an immediate concern. I think we're basically there at that 2%. I think the Fed shouldn't change the rules in the middle of the game right now. And I think we will get there.
I think the UK reported a 2% number today.
Yeah. Surprisingly, and they had the worst. They were the only country, by the way, that at the peak had worse inflation than us. Of course, they import all their energy, where we are, supposedly energy independent. We shouldn't have had that peak, when Russia invaded Ukraine, because we had our own energy. But that was because the Fed flooded the system with so much money.
Mm-hmm. So the other elephant in the room, big year in the U.S. election. Actually, lots of elections happening everywhere this year around
Yeah.
the world, and Canada next year. Should this play into people's approaches to markets, do you think?
No. It really shouldn't. I mean, I can argue which one is marginally better than the other. Generally the Republican plans will be better than the Democrats. But one thing that struck me was Biden about 4 months ago took credit for the stock market getting all-time highs. He said, "Look, I'm doing great for the stock market too." Now, not just Donald Trump doing great for the stock market. It's hitting all-time high. Well, I don't remember any president taking, Democratic president taking credit for the stock market hitting highs. But we live in a different world. 52% of Americans directly or indirectly own stocks. It's not a narrow group of people. Now, a narrow group of people own a lot of wealth in stocks, but everyone has a stake, and everyone's going to suffer if either Dems or the Republicans do something to damage the stock market. So I think we got to think about that. I mean, Biden, for whatever failings he has, is not a Bernie Sanders that wants to socialize the economy and, raise taxes on everything and anything. We avoided that. So I say, take a look at the long-term graph. Yeah, I have a chapter in my book about Democrats and Republicans, and which does better and what does worse. Actually, stocks usually go up more, believe it or not, during Democratic terms than Republican terms, but that is because they've gone up so much during Republican terms, they often get overvalued at the end of that. But in the long run, it doesn't matter. And it doesn't matter, I think, on either of these two candidates. They're both not anti-capitalist. One is more friendly than the other, but they're not anti-capitalist. You take a look around the world, you do see anti-capitalists and populists and others that are running, against just the wealthy and the stockholders. So fortunately, we do not have that.
So basically a non-event.
I wouldn't say non-event. I mean, I think it's going to be exciting. Next week from tomorrow, I'm going to be watching those debates, and next 3 or 4 months is going to be exciting. Everything's going to be exciting except all the ads on TV. Since I live in Pennsylvania, which is like the key swing state, I'm going to be flooded, and I'm not looking forward to that with ads.
Yeah, have fun with that.
Not much fun, Michael.
So I got time for a couple more questions, and one just sort of, do you think, are there specific sectors that you believe that are positioned to do well, sort of going into the second half of 2024 and into 25?
Well, I am basically a value stock guy. I like long-term because long-term value stocks do better. But we've had the longest period of time when value stocks have underperformed growth stocks in our history. I mean, we have 100 years of history on individual stocks where we've got real good data we can put them in. I mean, we have 200-year history on the overall market that I've done, but on individual stocks, 100. There's never been as long a period where value stocks have underperformed growth stocks. Now, when that will reverse, nobody knows. It could be, in my opinion, when interest rates start going down. That could be the sign, because a lot of small companies and value companies, they roll over their debt short term, not long term. They haven't fixed it in. They can't afford, what Apple and Microsoft and NVIDIA can do. And they roll over, and they want to roll over at lower rates. So it might take that lowering of rates to boost those value stocks and finally put them on equal or better footing. They're certainly cheaper now than the growth stocks.
Yeah, fair enough. So last question, just going back to this original book, and I know I'm going to get edition 6, but you made a great point, and that's one thing about these books is you can look back over time and see how things have worked out. You made a point in the book about how the baby boom at that time was going to change the stock market forever. And my question to you now is, are there demographics or changes you see occurring that will change the market going forward from this point?
Well, I mean, what I see is people are counting on stocks as a major way to get the savings that is needed. You don't trust the government on Social Security. You don't know whether it's going to, how it's going to go through for your own, Medicare. Will it be able to pay everything? People are going to be needing to save and accumulate in stocks as they get older. Now, eventually that money will turn over. It'll be bequested to younger generations, given to charitable organizations, and turned over. But in the meantime, people are looking for vehicles of the creation of wealth. And I think it's going to be centered in the stock market.
Okay, well, same philosophy. Fantastic. Any last words for us before we close off?
No, I'm really pleased to see it. I'm looking at your background with all those mountains with the snow in there. We're having 93 degrees here in Philadelphia.
Yeah.
So in a way, that is a very refreshing look, Michael.
We try to be refreshing. So, folks, that concludes our webinar for today. And thank you, Professor, for joining us. We really appreciate it. Thank you, everyone, for logging in. And please, come to our website, have a look at other information on our ETFs and how they may help you attain your goals. So thank you very much, Professor.
Thank you.
Have a great night.